Hi, we are back working on problem 526 again. I just did all these journal entries. Now we're going to do the T accounts, alright? But we're not going to do all of them. It tells us to just use the T accounts for materials, overhead control, and work in process, and finished goods. Post the relevant entries. Now, of course, in real life, you have general ledger accounts for all these accounts we just journalized. We represent them with T accounts. And we also have a few of these accounts have balances. So the materials inventory, 7,500, work in process, 37, finished goods, 50. So we're going to get our T accounts going, put our balances in, and then we'll just go back and get the journal entries we did and use our journal entries to post to the T accounts. Alright, so materials starts out with a balance of 7,500, so I guess we need to put that there. And of course, materials being in inventory, when they just tell me it has a balance of 7,500, I know that it's going to have what's called a normal balance, which for an asset is always going to be a debit, right? The normal balance is whatever increases it. Work in process, another inventory, has a $37,000 balance. Alright, and finished goods inventory has a $50,000 balance. Alright, so there we are, starting out with our balances, and overhead control has no balance. So then we did these transactions. So I'll just pick out the accounts we're talking about. Obviously, when you post to the ledger, you post both your debit and your credit. But we're just trying to make sure we understand how these inventories flow into each other. So we're just going to really deal with these inventories. So transaction A, we did have a $60,100 debit. So of course, debit, credit side. So transaction A, 60,100 materials moved into, we bought those materials. Transaction B, there you go, we affect all three of them. So transaction B, we debit work in process, 50. We debit overhead con, 8,800. And we credit materials, 58,000. All right. Next transaction, we have work in process and overhead. We aren't going to post these. In real life you would, but we're just going to put a $75,000 debit to work in process and $36,000 debit to overhead. Oh, I'm sorry. I wrote that on the wrong spot. $75,000 goes up there, and $36,000 goes down there. All right. Now the next transaction, D. All right, overhead, 10,004, but we're not worried about that depreciation, so we'll just debit overhead 10,004. Next transaction, again, we don't care about that little liability there, but we'll take that overhead con, debit 1,450. Next, another one, 6,200. That was F. All right, and G, 5,500. Filling up our overhead. What's next? Selling expense and cash. Oh, we don't care about that. Admin expense, selling expense, accumulated depreciation. We don't care about that. Admin expense, account payable. Don't care. Here we do care about. Work in process, $72,000 debit. That's K. And it's also a 72,000 credit for overhead. So 72,000 transaction K. Alright. And then there was this other one I didn't quite have room for. And those are something. So we want to debit finished goods. 160. That's transaction L. And work in process, credit at 160. Alright, and that was transaction L. Alright, so now we've posted all of these journal entries to our ledger, right, which is taking the form of T accounts. So now it's time to get our balances. That's part of what you do, right? So 7,500 plus 60,100 minus 58,000 gives us an $8,800 balance now in materials inventory. So there's $8,800 worth of materials sitting around in inventory. Work in process. We add all these guys up, we subtract this guy, and that ends up being $74,000 balance right there. All right, finished goods, no credits, so that's sitting in our inventory waiting to be sold. 50,000 plus 160,000 is, we have $210,000 of finished goods sitting in finished goods. Once they're sold, they'll become cost of goods sold. And overhead, we add up all our overhead, we subtract all that we applied, and we see that we have a credit balance of $36.50, right? So that means this side was bigger than this side, right? And so that means we've over-applied our overhead a little bit. In other words, by using our rate, we actually applied a little more, right, than we actually spent. All right, so that's okay. We take care of that at the end of the year with our journal entry to cost of goods sold to take care of any variance in overhead. All right, so I'm going to stop there and we'll go on and do our statement of cost of goods manufactured.